The United States dollar became the world's reserve currency back in 1944, and that move made the United States of America the world's economic superpower. Now, one of the many reasons why the world trusted the United States dollar is because our dollars were backed by physical gold. Let me show you why that matters. The United States government generates revenue from tax dollars from taxpayers. And then they go out and they spend this money. Where do they spend this money? They might spend this money on healthcare, welfare, infrastructure, military, and everything else. Now, you might think that because the United States government is so large and powerful that we're not going to spend more than we generate from taxes, but we do not run a balanced budget. What that means is the United States government generates these tax dollars and then they spend all of that money and then some because we go out and finance that additional spending through debt. This is where you need to understand where these additional dollars come from that the United States government spends. The United States government can borrow money from people like you and me. That's called a treasury, meaning we lend money to the United States government in exchange for interest. Foreign countries around the world are lending money to the United States government because they trust the United States government and they want to be paid back with interest. And if the United States government cannot get enough money from regular people or foreign countries, then they will go to the central bank in the United States called the Federal Reserve Bank, and then the Fed will then print that money and give it in the form of a loan to the United States government. And I should let you know that although they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not federal. It says so on their website. They're not a part of the federal government, but they have the ability to create this money out of thin air. Now, you need to pay attention to this. When our dollar is backed by physical gold, there's a limit to how much money the Federal Reserve Bank can print. Why? Because if we want to print more of these dollars, we need more wealth, we need more collateral, and the collateral is the physical gold. This gold-backed money helps to preserve the value of the United States dollar because it limits how much money we can create out of thin air from the Federal Reserve Bank, but it also slows down economic growth because our economy runs on spending. The more money you spend, the more money somebody else makes. And in our economic system, the largest spender in the United States economy is not you, me, Amazon, or Tesla. It is the United States government. And so when the United States government spends more money on infrastructure, they hire more contractors, they spend more money on research and development, those are money going into the hands of businesses' pockets, going into the hands of people's pockets. So when the United States government spends more money, it grows the economy. And I mean, realistically speaking, if we could just print money out of thin air, could you imagine how reliant the economy would be on the United States government? Because then the government could just print money to fund infrastructure projects, print money to fund welfare checks, print money to fund whatever they wanted. And that's kind of what's happening. In the early 1970s, the United States government had borrowed so much money. We had taken on so much debt, not just from the Federal Reserve Bank, but from countries around the world, that countries were getting concerned about the United States government's ability to pay back that debt because we had so many expenses and we had so much debt. So now these foreign countries and these large institutions said, you know what, you keep the dollar, just give us back our physical gold. And so gold levels were dropping in the United States because everybody who had lent money to the United States said, just give us back of physical gold, and that was when. In 1971, President Richard Nixon stopped that. He severed the tie between the United States dollar and physical gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Now, if you notice what he said this was temporary, and here we are 54 years later, and the dollar is still not tied back to physical gold. But that move to sever the tie between the United States dollar and physical gold started to create concerns about inflation, because if you can just print this money out of thin air, and now this money isn't backed by physical gold, it's just backed by a promise that the United States government has value. It's backed by a promise that the United States government is going to continue to pay their bills. But it's still there, it's still the world's reserve currency, but you can start to see how some people started to get concerned about the value of the dollar and inflation, but those concerns were relatively quiet after the 1970s until 2008. After the housing market crashed and the economy was in free fall in 2008, the Federal Reserve Bank unleashed something called quantitative easing. And this quantitative easing was essentially a fancy way of the Federal Reserve Bank saying we're going to print $1 trillion out of thin air and we're going to inject this money into the economy to get the economy moving. That means the Federal Reserve Bank printed more money, lent it to the United States government. The government then spent that money hiring people, building contracts, giving money to businesses to keep the economy moving again. And after the quantitative easing started happening in 2008, that's when people started to get concerned about the value of the dollar again, because if you can just print this money out of thin air, what is the real value of that dollar? And it's a valid argument, because if you can just print this money out of thin air, why do we have to pay taxes in the first place? Why do we have to work for the money? Can't the government just print the money and give it to us? But by 2012, it looked like things were okay. The economy started moving again, and the dollar was still strong, and concerns about the dollar started calming down. And then came 2020, and things got flipped upside down again. Now, I do want to remind you that for those of you that are investors or want to become investors, I put together a free investing masterclass where I'll walk you through how you can get started as an investor and how you can find hidden investment opportunities before the crowd, before they hit the headlines on CNBC and Reddit. These are the same strategies that the team at my firm uses when we are analyzing investment opportunities. So if you want to watch this investing masterclass, it's completely free. All you have to do is register. I have the link for you down in the description below. And when you sign up, you're also going to get Market Briefs, my newsletter for investors, for free as a bonus. So I have the link for you down in the description. When the pandemic hit in 2020, the economy was shut down and the stock market saw its fastest sell-off since the Great Depression. And that was when the Federal Reserve Bank started printing money again. This time they did not call it quantitative easing, but it was essentially the same thing. It's estimated that the Fed printed around $5 trillion to stimulate the economy and keep it moving after that pandemic hit. Now, it can be hard for our brains to really process and understand how much $5 trillion of money printing really is, but to help you understand, in 2019, it took the country of the United States of America, about 300 some million people, working for 1 year, 365 days, to produce about $21 trillion of wealth. The economy in the United States was about $21 trillion large, and then the Federal Reserve Bank printed about a quarter of that, $5 trillion, with the push of a button. And this new money printing is what got many people now concerned about the value of the dollar again starting in 2020 because of what the Federal Reserve Bank was doing. But interestingly, during that same time, many economists were saying, no, all this money printing is not going to cause inflation. In fact, it will probably cause deflation. Inflation is when the value of the dollar becomes weaker, causing the prices of things to go up. Deflation is the opposite, where the prices of things are going down because the value of the dollar is ultimately more strong and it can buy you more stuff. Well, it turns out there was inflation, and when we started to see that inflation in 2021, that was when the Federal Reserve Bank went out and said that this inflation that we're seeing is just a transitory problem. It is a temporary problem. Now here we are in 2025, 5 years after the pandemic money printing. Nearly 2 decades after the quantitative easing money printing after the 2008 crash, about 5 decades after the dollar was taken off of the gold standard, and 81 years after the United States dollar became the world's reserve currency, and people are starting to get more concerned about the value and health of the United States dollar. Guardian recently published, "Trust in the United States dollar is eroding. The question isn't if the dollar will lose supremacy, it's when." JP Morgan Chase Bank said de-dollarization is the United States dollar losing its dominance, and BlackRock, the world's largest asset manager, says that a declining dollar means more international exposure. And on that note, and kind of interestingly, the CEO of BlackRock recently did an interview where he said that the United States dollar could be replaced by Bitcoin because of all of our national debt. So now that you understand what's going on, let me talk about what this actually means. Does this mean you should panic? No. Does this mean you should come to a rash conclusion? No. Does this mean the dollar is going to crash tomorrow? No. It means you need to understand strategically how to allocate your money. Now, for full transparency and full disclaimer, I still think the United States is the best place to be and the best place to invest your money. But we can start to study what some rich people, some wealthy institutions, and what some of the big banks are doing to diversify themselves as well, because we can learn from others. My team and I have been studying some of the largest asset managers and largest investment institutions in the world, and we saw a theme that there are 4 places that investors are looking to diversify their money if they have concerns about the dollar. Where are they? Number 1 is physical gold. Number 2, it's in real estate. Number 3 is in foreign businesses. And number 4 is Bitcoin. So let me go down this one by one to help you understand, starting with physical gold. It takes time, effort, and labor to mine physical gold, and there's a limited supply of physical gold in the world, and gold has been the historic money And so that's why some investors that are concerned about the dollar, they're concerned about inflation, they will buy gold when they have those types of concerns. Now, another reason that gold prices have been booming over the last few years is because there are some countries around the world known as the BRICS nations, B-R-I-C-S. That's Brazil, Russia, India, China, and South Africa. These countries have been working to potentially move away from the United States dollar and create their own currency that could be backed by physical gold. So we've been seeing more central banks around the world start to buy up more physical gold as a way to strengthen their currency. And so there's a lot of reasons why investors have been going to gold post-pandemic, but it all stems from concerns about the United States dollar. But I do want you to understand that nothing goes straight up in price, including physical gold. And this is somebody telling you this who's been buying gold for a number of years now. Let me just show you what I mean. This is a chart showing gold prices, and what you can see is that gold prices boomed after the 2008 crash because everyone was concerned about the United States dollar collapsing. So people looked for a way to protect their money, and the way they did that was by buying gold, and gold prices shot up. But then by 2012, it became more clear that the dollar was safe. And people didn't want a safe investment, they wanted to take more risks. So that's when they dumped gold and went back to normal investing, and you saw gold prices fall from 2012 to 2013, 14, 15, 16, all the way until 2020 when the pandemic hit. So it took 8 years for gold prices to recover after 2012. The reason why I'm telling you this is because if concerns about the dollar stay, well then that can help the price of gold continue to rise. But if concerns about the dollar start to go down because things start to stabilize, well then people might start ditching gold, looking for better investments, which could cause gold prices to fall. And so you have to understand that nothing goes straight up, including the prices of gold. And when I invest in gold, again, I can't tell you what to do. I'm not a financial advisor. I'm just a random guy on YouTube. But when I invest in gold, I don't look at gold as an investment. I look at it as a way of saving hard money, because my theory is if I save $10,000 in my backyard and I save $10,000 worth of physical gold today, the gold may have more buying power, or I believe it'll have more buying power because of inflation. But that's my thoughts. So if you are interested in gold, just understand what moves gold prices up versus what moves gold prices down. Number 2 is physical real estate. I like real estate. And the reason why I like real estate is because unlike gold, this real estate can produce income and it has real value. So the reason why a lot of investors are turning to real estate as another hedge is because real estate is a hard asset. It's something that you can see, feel, and touch. When you own real estate, you own the bricks, you own the land, you own the windows. Versus when it is physical gold, that gold is just sitting there looking back at you. This real estate can then work to produce an income. So the advantage of real estate is you own something physical, and if the value of the dollar goes down, then ultimately the price of the real estate would go up along with the rental prices. And if hypothetically, worst case scenario, I'm not saying this is going to happen, but just stick with me for the purposes of this example. If the dollar were to collapse, which I don't think is happening, but if that were to happen and the currency became chickens, you could charge rent in chickens instead of United States dollars because, well, that real estate still has value that you can give in whatever form of money currency that you want. Number 3 is foreign businesses. And what that means now is instead of investing your money into United States companies, which are really affected by the United States dollar, some investors and institutions have been looking at foreign companies, foreign stocks. Now, investing in a different economy can be difficult, especially if we don't know how to actually go about doing it, but there are much simpler ways by using the United States stock market to get exposure to funds that are giving you ownership into those foreign companies. For example, again, I'm not telling you what to invest in. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But there are ETFs out there. These are funds that you can buy in the United States to give you exposure to foreign economies. So, a couple examples, again, I'm not telling you what to invest in, are VEA and IEMG. VEA is an ETF created by Vanguard. That's one of the larger investment institutions in the world, and this is an ETF that gives you exposure to developed economies outside of the United States. So, the more established countries around the world, you can get exposure to those economies by investing in this fund, which owns stocks in those developed economies. An alternative is IEMG. This is an ETF created by iShares, again, a large investment institution backed by BlackRock. And this ETF invests in emerging market stocks. So now we're not talking about the developed economies, we're talking about the smaller economies, smaller countries that are growing, more risk for more potential return. Because now not only could you see the companies grow, but the countries could also grow, which means, yes, you could see a lot of potential upside, but more risk because it's not as secure and safe as the United States economy. It's not as secure and safe as the United States military. It's not as secure and safe as the United States dollar because still the United States dollar is the world's reserve currency. But if you are interested in diversification, that's something that you can consider. And number 4 is in Bitcoin. Now, Bitcoin is the newest asset class. This is something that was created that is interpreted to be a digital asset, kind of like physical gold. However, we've seen a lot of volatility with Bitcoin. We've seen a lot of Bitcoin crashes over the last 10 or so years, which means, yes, people look at Bitcoin as a digital gold. People use Bitcoin as a way to protect themselves against inflation or the falling dollar. However, it hasn't been around the way gold has, or real estate has, or investing in stocks has. And so understand that, and understand that it comes with additional risk, more potential upside, more potential risk. And your job as an investor is to be able to manage the risk, manage the upside, and find the right investment opportunities for you. And that's one of the things that I talk about in my investing masterclass, is how you can build an investing strategy and find investment opportunities that work for you before the crowd does. So again, if you want to watch the investing masterclass, I have the link for you down in the description. And this is where it's important for you not to panic, but to understand what's happening. Because a lot of people tend to get very emotional, and emotions are the enemy of profits. But any changes that happen are slow moving. And by watching this video, now you are ahead of the vast majority of the population. And this is where I want you to understand what's happening and be able to position yourself in a way that can capitalize on what's happening. But the only way you can do that is by understanding how it creates opportunities. So if you enjoyed this video, please, the best thank you is to share this video with a friend, a colleague, a family member, or a fellow investor. Now, I know there's a lot of content on the internet about creating passive income, but 98% of what you see is garbage. If you want to have enough income coming from your investments to fund your lifestyle, it is not going to be easy, and it's not risk-free. Investing has risks, but it is possible. So now, if you're still sticking with me, let me show you how you can actually do it.